Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. The key move here in recent times has been the move back down below the super significant 50% absolute Fibonacci line at 218.75. This has now quashed the idea of a handle, as that's actually a specific pattern addition to a rounded bottom, and also a bull flag come bullish halfway hesitation pattern formed from about mid-February to the end of May. Thus the primary target at 221.25 may have been achieved. It was achieved, but the secondary hardest reach target X1 up in the 238.25 area will be retired after this commentary. Now, unlike some of the other grain markets, we do not really have a double top pattern here, lopsided or otherwise. What we do have, and so far it is unhighlighted because it is not such a great looking pattern, is something I mentioned last week when I said, and I quote, "This now looks like we will see a test of the green short medium moving average, currently at 213 even, as well as a congestion at 211.25 before we meet the mid-February to date uptrend, currently at 209.75. In many ways, this could be the last chance for the bulls out there, as it might be part of a very big February to date bull channel. But a lot of this is just speculation right now, as even this bull channel is at most a 4-pointer and does not have the necessary touches. However, for now, that is all the bulls out there have to hold on to." End of quote. Now, it still is all the bulls really have to hold on to. And the lower bull channel line has been pierced today, yesterday and today, closed below yesterday, about to close, we have closed below it today as well. Underneath it we have the rising mauve medium moving average, which is currently at 205.75, as well as the lows of May and April around the 204 zone. I would also include the congestion seen between December 18 to February 2019 between 204 even and 208 even. So perhaps this might be a bit more substantial as support as it might seem at first glance. So watch this space. I'm not very comfortable about that uptrend, but watch this space. 5 weeks ago, Minneapolis wheat. 5 weeks ago I made the following observations and comments, and I quote, "A March to late April hesitation within a mid-February to date bullish halfway hesitation, much as I originally saw in oilseeds and veg oils, and then again today in the grains. This is in addition to another earlier pattern which I described 2 weeks ago," so that's actually now 7 weeks ago, "when I said," and I quote, "This brings us to the bigger picture here, and we have the same rounded bottom here you'll see in the other grain markets based on the November 2017 high at 665.75, which in turn gave us the key June 25 high that was the start of the rounded bottom." End of quote. Now I further added 4 weeks ago, and I quote, "Can now verify the targets for this bullish half hesitation of a primary target up in the 684 area and a secondary harder to reach target up in the 723 area. As you can see, we have traveled all the way on these targets, indicating that this market is farther advanced than Chicago and Kansas City. There is now opportunity to lay out some targets for this rounded bottom of a primary target X up in the 737.5 area, so not too far away, but a secondary hardest to reach target X1 up in the 774 area near the top of my daily chart." End of quote. Whilst the topside targets for the halfway hesitation proved to be good, those for the larger rounded bottom have not been so fortunate. And though we came close, tantalizingly close 2 weeks ago to target X at 737.5, we have still failed to reach it, and both target X and target X1 will be retired after this commentary. Additionally, what I called 3 weeks ago a first effort basis, a dark blue mid-April to early May quite acute bullish shift pitchfork, has failed to contain the market, and I will likewise be be retired after this commentary. Indeed, the drop in prices pushed below the green short medium moving average, currently at 678 3/4, as well as the significant 50% Fibonacci line of the May to August 2024 move at 669.5. The importance of this 50% Fibonacci line is that it is also the base of a mid-April to date double top, Adam and Eve type, and the break below the 50% Fibonacci line is the follow-on lower move. Thus, for this pattern, we have a primary target X2 down in the 635.25 zone, right on the April 24 low, with a secondary, harder to achieve, target X3 down in the 606 zone, right on the April 21 low. Right now, the market has been halted by the slowly rising mauve medium moving average, currently at 643 3/4. And I'll be very interested to see if the market can make that short leap lower to the April 24 low. London UK feed wheat. There are two key long-term patterns here to bear in mind, with a common neckline extension highlighted in dark blue on my daily chart, and that's currently at 169.20. Please remember this level. I'll shortly detail these patterns. But first, I would like to discuss some of the recent actions, how some of them failed and how others succeeded, and what may be next. We had a July 25 to late April 26 very large rounded bottom pattern. This had a first peak at the 50% absolute Fibonacci line at 180.5, and the recent move higher was done by the bright red early March to mid-April bull channel. Prices broke higher out of this pattern and with some vengeance late 6 weeks ago, stabilizing and exploiting the move higher with a significant move up over the purple middle time, currently at 183.65 of the end of June to late October 2025 bullish shift pitchfork. I spoke about this bullish shift pitchfork 7 weeks ago when I said, and I quote, "This pitchfork has so far not been tested, so this will be a first if we continue to move higher," end of quote. Well, the middle time did help cap prices for a while, along with the bright red upper bull channel line, but as is seemingly always the case when two such resistances are close together, rather than capping prices, it gave the market the opportunity to knock out two resistances both at the same time, which is what happened late 6 weeks ago. As a result, I added some targets above for the very large rounded bottom formed between July 25 to April 26, with a primary target X in the 199.60 area, with a secondary hard to reach target X1 up above the top of my daily chart in the 212 even area. This whole idea, as I said last week, was now under threat as the market created a late April to end of May head and shoulders top, a bright green neckline currently at 185.90. Late last week we broke down through this bright green neckline, and this week we have moved below the 50% absolute Fibonacci line at 180.5, and also the rising green short medium moving average currently at 180.80, slowing down today ahead of the slowly rising mauve medium moving average currently 173.30. I said about this head and shoulders top pattern last week, and I quote, "I am not able to give any targets below for such a move as we have not broken lower and not verified if this is a head and shoulders top, a bearish pattern, or a head and shoulders continuation pattern, which is a bullish pattern. Then I can only give some possibilities. Thus, a primary possibility low would be about £5 under the confirmed break of the bright green neckline, and a secondary possibility, a harder to reach possibility, of about £9.85 under the confirmed break of the bright green neckline. Even with the secondary possibility low, this would only approach but not break the important dark blue neckline below, though this of course does not account for any follow through lower," end of quote. These possibilities lower now translate to a primary down in the 180.70 zone, a target that's already been achieved, and a secondary harder achieved target down in the 175.85 zone, a target that has been achieved today. So, with all this in mind, let me now discuss the longer term points once again. The same points I've been discussing here for over a year, as some of them was something that I noted back in my annual commentary back in January 2025. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to April 25 bearish cat's ears pattern akin to a double top, but formed after a big fall such as the fall we had in early 2023. As well as this, we had an even longer term second pattern, an August 20 to April 25 very large head and shoulders top pattern. These two super long term patterns both rely on one single feature, and that is their common neckline, which is highlighted in purple on my monthly chart, and is currently 169.20, the same as on the daily chart I just spoke about. From these two longer term bearish patterns, we have a primary target X3 for the bearish cat's ears pattern down in the 127.5 zone, and a secondary hardest reach target X4 down in the 112.85 zone. For the head and shoulders top, we would have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 250 or so charts. The 1975, yes, a half-century old uptrend, currently at 66.30. I'm not even going to give you my secondary hard to achieve target for this pattern, as it's down below zero. Please bear in mind that these are very long-term targets, stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July 25 with changeover through a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the bright green 2023 to date upper bear channel line, currently at 169.10. The question this posed, and is a longer term question, is whether July 25 was just a reactionary single month move higher or the beginning of something else. I said for about 2 months now that these two bearish patterns will not be the way forward, and that what we have is a base for a move higher. March provided a single monthly close barely above the bright green upper bear channel line. April did not much better with a clean, clear close higher. However, it did actually manage to do it better. However, I would have said repeatedly here, I would like to see a minimum, at least 1 month ideally, the close of May, over the bright green upper bear channel line to verify this move higher, and ideally over the 50% absolute Fibonacci line. And that's at 180.5. Now, we have seen a strong close for May, but the pattern for May was a bearish one, a shooting star pattern type 1 bearish, and June has already started gapping lower, a follow-on move down. This now throws the idea of a reactionary move back up into down, as prices seem set to move down to the important common purple neckline once more. And it does raise the question whether the whole 2023 today action could be the start of yet another pattern, perhaps an opportunity for a very large reverse head and shoulders pattern, perhaps. So watch this space. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.